Alright, welcome to this video. I'm John Eastman. Thanks so much for joining me today. Today I'm really excited to share with you a swing trading technique that utilizes options that's called Johnny 4. And I'll explain in just a few minutes why it's called that, but the history of Johnny 4 is that Johnny 5 was a lovable robot in the movie Short Circuit in the 80s. That used to be a favorite of mine when I was a youngin'. So this is Johnny 4, and you're going to see why in just a minute. This is a swing trade, as I mentioned, but it is a mean reversion technique where in the other videos we went over how after a while the markets kind of either run out of buyers or sellers temporarily. Um, when there's a certain number of days that are straight up after a while, you can usually expect the price to come down some, and then maybe it'll go back up or it'll drop all the way back down to where it was or to the most recent gap. But this is going to capitalize on these little short-term reprieves or contrarian trades, as one of my mentors like to call them. So it is a mean reversion technique, and it is considered a swing trade. This technique can be used either bullish or bearish. And we always have to remember this: patience. Patience in trading. There's many different signals for this technique. There's many different trades. We can let one go and always know that there are other profitable trades just around the corner, sometimes the exact same day. So patience is always the key, as we can remember. Then let's have some fun. This is exciting. To know these techniques is punching a ticket to basically print money for the rest of your life. So that's exciting. So just have fun with it. Learn the technique. It's a pretty simple technique, but it's been time tested for many years by some really great teachers and perfected to share with you here today. So as I mentioned, I don't know why I have to say it's a mean reversion technique again, so I'll skip that one. This can be used on stocks and ETFs, but it does indeed work better on stocks. So I would highly recommend to just start using it on stocks. The list of swing stocks are downloadable. If you're a student, you've already received it. If not, you can download it in the members area. These are stocks that have enough volatility and average true range, which means each day how much does the price actually move up and down, to be able to make some good profits using options with usually within a few days. So this can be used for bullish or bearish trades, and I will show you the bullish version here. The bearish version is exactly the opposite, and I can give some examples of that. It can also be used with a double up strategy, where if the strategy continues to go toward the exhaustion point, we can double our position, and that's in one of the other training videos. But just use caution. This is not financial advising here. I am not a financial advisor. I just have to say that all of your risk is your own, and use your own judgment as to what risk is gonna be good for you, so that you can make great profits, but you're not, sitting in your bed in a cold sweat at night because you don't know what's going to happen to your swing trade the next day. So, we are looking for a short-term reprieve from the overall trend that we can use to trade, and I like to think of it as built-in profits. That's what excites me about it. That's what I think is fun, is it's like you already should have profits built into it, so they happen relatively quickly, usually. So what we want to do is we want to set up on our chart, and I'll get into this in just a minute, on the actual chart on TradingView, one of my favorite sites to set up charts, tradingview.com and stockcharts.com. I use frequently every single day. And so, as I said, we don't want to go against the trade, and you'll see some things repeated here, but it's good. The repetition is really good for learning and getting it into our cellular memory so that we can remember these techniques and use them, hopefully, for as long as we choose to trade. years and years to come, decades. We could teach them to our children, our grandchildren, great grandchildren, so that they can have success in the markets too with these really fun uh, short-term swing trades. So this is something I emphasize very much with some of my students who are beginners and even more advanced students, is that when you're first starting out trading, it's best to not try to trade against the trend. Meaning if something's very, very bullish, we don't want to go bearish. Or if something's very, very bearish, we don't want to go bullish until a time when we have a specific signal that the trend has changed. And you can check that out in the 3-bar swing high and low video. You can check it out in the 55-day channel breakout. The channels will tell you which way it's going. But it takes quite a bit more skill, and you can really get crushed if you try to bet against the trend of a strong trending stock or market. So for this, we're going to go with the trend, but we're going to place our trade once we've seen that the trend is still strong in one direction, but it is on a dip or a reprieve. It is becoming oversold in a bullish market or overbought in a bearish market. And this is the technique I'm going to show you in just 1 minute. Johnny 4, here it is. That's why I call it that, because we are going to be looking at 4 out of 5 bars that close down in a trend. As long as the close of that day, we're going to use daily charts and daily bars, is above the 200-day moving average, and at the same time the close of that day is below the 5-day moving average for a bullish pattern. Okay, so we're going to always start with bullish. I'll go with bearish second, because overall the stock market over the years is usually going up, and it has gone up. It's mostly over the long term bullish. So I will always start with bullish. So you want 4 out of the 5 bars to close down from that first bar before it. Okay, but we're still above the 200-day moving average, and we are below the 5-day moving average for bullish. If it's bearish, it's the other way around. We are below the 200-day moving average, and we are above the 5-day moving average for a bullish trade. And I will show you in just a minute. Just don't worry if you don't get it just from me explaining it. Trading is very much visual, so I will show you. So you want to buy market on close of the 4th down day out of 5, as long as it is below the 5-day moving average. It meets the criteria. And this is how you start. For the more advanced traders and the traders that understand, which we have, Jerry is one of them. He's a master of intraday reversals and patterns. Congratulations to Jerry. He did 50% return last month, trading very part-time while he raises a beautiful family and runs his family business. So congratulations to Jerry. You'll see him in some of the other training videos if you haven't already. So just to keep it simple, buy on the 4th down day of those 5 total days, as long as it is still above the 200-day moving average. The price point is still above the 200-day moving average, and the price at the close of the day is below the 5-day moving average. So I'm going to show you an example now, but this is just how you will exit. Okay, and you can go over this over and over till you get it, or if you get it right away, happy trading. I'm just kidding. It's usually good to run through it several times, get used to it, get used to and comfortable with your entry and exits of any trade or market, so that you don't get caught off guard and get rattled, which potentially can happen to anybody, even experienced traders of many years. So how do we get out of this trade? Once the stock price closes above the 5-day moving average, we sell on the close of that day. And that's it. It's usually within 1, 2, 3, maybe 4 days, sometimes more. But when we have an option, we ideally want it to snap back and close above that within less than a week so we don't decay too much. We still maintain a profit. So here we are. I'm going to show you right now how this works. All right. So without showing too much of my desktop. Okay. So the market is actually open right now, but I'm going to go back to Netflix in February actually. Yeah, these were times of the big, there's a big correction. Now these techniques, boing boing and all of this, the greatest thing is that the rules still apply. If you see a major market sell-off, you might want to wait a little more, take a look at some other indicators, but the rules still apply, and especially enhanced boing boing. When this thing dropped down that much and it was so oversold, there's opportunity there to use those swing techniques. So this is live right now. So here we have Netflix as an example, which is has been a great growth stock, has enough movement. It is on one of our swing lists. So here's the example. Here we have the 200-day moving average right here, this line. That's the 200-day moving average. Okay? And we're looking at Netflix here. So Netflix is in a, very strong bullish pattern right now. You look at, it's always stayed above that moving average. And then it kind of went sideways here, but here it's shooting up. So here's our example for the technique, and this is as simple as it gets. Close of this day, 277, 278.65 about. Okay, that's our starting point. So we have one down day, two down days. No, all right, sorry, here's our starting point. That's what I thought. Close down here, close down here, close down here, up day here, closes down here. This is where we'd enter. Okay? So this is a mean reversion exhaustion technique using different criteria than some of the other ones. Alright, so we had 4 straight up days here. Okay? This is still a bullish bar because it's green. You see it, meaning just a little review. I'm saying some things that are probably obvious, but I want to bring the whole system together. This is how I trade, and it's been very effective. Which is the price closes higher than it opened. Now, but we want 4 days in which there is a lower open than the close. So we have 1 down bar, 2 down bars, 1 up bar, which is okay. Sorry, okay, hold on, I keep not counting this. Okay, 1 down bar, 2 down bars, 3 down bars. Here's the fourth one that's okay. We have 5 because Johnny 4. Here we go. Here's the 4th down day out of the 5. So we can buy market on close here, about 254.20, around there. Or we could buy market on open the next day. But it's, it doesn't make that much of a difference. On this we make more profits, but here you go. This one only took 1 day. 254.20 we buy. The next day closes just above that 5-day moving average, 265.68. So $11 on the stock, nice little profit on the option. That's it. That's the technique. So let's see if we can find another one. Yeah, here's one. This one took a little bit longer, but it doesn't matter, it still works. Here's another one where obviously I don't even have to say on this particular stock that we are above the 200-day moving average, because we just saw that for the many months now it has been above it. This has been a very bullish stock. So here we go. We have, this is where we're starting. We have one down day, two down days, three down days, four down days. This is where we can get in. Would have been nice if we got in there. I mean, again, when you understand the intraday patterns, you could have, but at least we'll get this. Okay, so it is 184.08 about. We get in, and this doesn't quite close above the 5-day, but 1, 2, 3 on the fourth day, pop. 188.60. So a little profit there, I think it's short enough that we would have definitely seen a little bit of a nice profit on our option. Not as big as the other one, but still a profit on this, simple rules to follow. And then boom, we get out, and then it goes back down. So we lock in all those profits. Okay, let's see if we can find another one. 1, 2, 3. 1, 2, 3, 4. That doesn't quite cut it. We only have 3. We want 4 out of 5 down days. Let's see here. So here's one that's flat or even, really. It looks like one down day, up, 2, 3. No, that was up. That doesn't count. Let's try. I think we'll find something here. This is a good spot. So 1 down day, 2 down days, 3 down days, 4 out of 5. Buy here. Kind of go pretty much sideways there, and then we close above the 5-day moving average. It's $4 on the stock. It's a little profit there within 3 days. So we buy here, the market close of the 4th down day out of 5, and we sell here out for a profit. Now let's take a look. I think this is let's see if we can find one more. 1, 2. This one comes pretty close. Let's see here. 1 down day, 2, 1 up, 1 down. No, we wanted it to be at that one. We're going to skip that one. So you can get as picky as you want with your trades to be more profitable. So here we go. Let's see. This may be one. So we have, this is our starting point. Down day, down day, down day, down day. So we've got our 4. 1, 2, 3, 4. We don't even have to count the 5th because they're all down. So buy here, and then boom, sell there. Sell there. Buy there, sell there. And that would be, nice little profit there. So next, let's try a bearish trade. So let's see what's been going down recently. I think so on the bearish side, we just kind of flip it around, and I'll show you in just a minute here. I mean, you can use it on the same chart, but here we go right here. Netflix turned bearish. Okay, now it's below the 200-day moving average, and this was years ago, a couple years ago. But man, here's an example. Wow, this would have been a nice profit right here. See, sometimes when you catch a gap, that's what's I find exciting. It's like you're gonna get a profit most of the time, but when you get a gap, you get some extra pop. All right, so here we go. Below the 200-day moving average, we are in a bearish pattern. Lower highs and lower lows. Down, down, down. Do we have it? Let's see here. Yes, we do. Let's start here. 4 up days out of 5. Up, 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 up. There it is. We're in a bearish pattern and we have a temporary bullish reprieve of that pattern. We buy on the market close here. Wow, this would have been a very nice trade. And look at this. The next day, gaps all the way down, $13. And we sell right here. That's it. It's that simple. So that would have been a monster profit. That's it. You're out after 1 day. Monster profit. Yeah, let's see. Up, up, up. That's not one. We're still below the 200. Let's see. Here's one that's a little profit or even. So we're below the 200. I mean, you could decide to get picky and just say this is too close to the 200. It's about to turn bullish. Skip that. But the rules still apply. So that's what's great about the rules on these strategies. They continue to apply no matter what kind of crazy stuff happens. So that's why we can stick to these rules and have fun with it. So here we go. Up day, up day, up day, up day. So we have 1, 2, 3, 4 out of 5. Let's see, where do we? So technically we would have got in here. We'd have sell here, and that would have been about break even. But I'm trying to see if we could have. Okay, so this was a down day. So 1, 2, 3, 4, 5. All right, so that good. We didn't have to get in on that bad one. So this is not an up day. This is a down day. So I was gonna say, I was like, man. So that's how the technique protects you. It's 4 out of 5 days. Johnny number 4. Johnny 4. Johnny 4 gets you more. Nah, I'm just kidding. Anyway, so 1, 2, 3, 4. 5th day on the close, we are above that 5-day moving average in a bearish pattern. See, sloping down. We buy here, and we just sell on the close of that below the 5-day. So here, a little profit there. Let's see, 102. 101, a little profit, possibly break even depending on the size of your positions. So far, I mean, this is a high percentage win rate on this. The bearish trades win a little bigger statistically. So far, I haven't found an actual loser yet, which is great. Not sometimes you do lose, but I haven't found one. So let me think of a bearish pattern. Company that's been bearish is well, gold has been. No, but that's an ETF. This works better on stocks. Netflix. Let's see, does it work on smaller? Under Armour. So, Under Armour, it started to get bullish again, but it was bearish for some time. And, oh man, we don't quite catch that gap, but let's see here. Let's see how we can find them. So here's one. This is under the 200-day moving average, right? We have 1, 2, 3, 4 out of 5 up days. Here's the 5th. Buy here, sell here, just 2 days, a quick profit. I actually like this example. I mean, ideally we use stocks over $50. You can make some great profits on ones that are under, but let me see if I can find some more examples. So, since it's a short-term technique, you don't really have to use anything that's particularly bullish or bearish. It does help sometimes to have that extra catalyst, but it's really just a short-term pattern, you know. So let's see. Snap was actually rather bearish for a while. Let's try this. Here we go. Snap. Again, I said over 50, but I'm just trying out a couple different options here. So we have 1 update, 2 updates, 3 updates, 4. Here's the 5th. So what we can do is, let's see, that's an update, so we could technically 1, 2, 3, 4, buy here. That is the 4th out of 5 days that are up in a bearish pattern because it's under the 200-day moving average. Then we sell our option down here. So, 70 cents on almost a over 6% decrease on the stock. It's a nice little profit there. So though that's Johnny 4. That's the technique. I'll get into doubling up in another video. But that's the overall technique. Let me see if there's anything else to add here. Just always want to keep mindful, like if there's some huge market crash going on, things are probably going to go down. If the market's, skyrocketing, they're probably going to go up. So it's good to keep these catalysts in mind. This works most of the time anyway, but it's good to really understand these rules and how to follow them. So let me see here. ALKS, there's another one. Okay, ALKS. All right, this is a $40 stock, so we're close to the 50. There's some good swings here. Here's an opportunity right there. 4 out of 5 are up. 1, 2, 3, 4. Okay, we're still under the 200-day moving average. We're following the rules. Wow, this isn't a monster profit. So this is an opportunity to get some gaps. So we have 1, 2. Actually, we could start here. Here's the 5 bars, and these are actually all up. So we could buy here or there, depending on how we count it. Then we have this big gap down there. That's almost 20% gap down. Monster profit right there. And when you're buying the options, since we only plan to hold for a few days usually, you can buy something maybe 3 weeks out to a month. If you can do 6 to 8 weeks and the options aren't too expensive, as I talked about in one of the other videos, the implied volatility is not too high. You can buy 6 to 8 weeks out to give yourself more time, but this technique usually doesn't take that long. We've seen, of all the examples, the most it took was 4 days, and usually 1 to 3. And there are some monster profits. We haven't actually found a losing trade yet. I'd like to see. Maybe I should go leave while I'm ahead, but and then in the 6 or 7 examples, we haven't actually found a losing trade, so that's good. Here's an example here, and this is another winner actually. Up, 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 up. Up day, up day, up day, down day, up day. 4 out of 5. Johnny 4. Here we go. buy at 47.67, and the next day we're down to 46. It's a nice little profit there. Nice little profit. Let's see, I'll try one more to see if I can actually lose on this today. Obviously there are losing trades, but let's see, 1, 2, 3. Nope, that doesn't count. Let's go back farther. That's above the 200-day moving average, doesn't count. Here's another one. This will work. So we have five days here, daily bars, and 1, 2, 3, 4 up days out of 5. Buy here, and then we sell. We take 3 days, but we sell here below the 5-day moving average. And I forgot to show you guys how to set up these patterns on TradingView. I apologize, but I'll just do that right now. You just press indicators, tradingview.com, press indicators, and then we go to moving average, which is right here. I already have it clicked. So these are, and then press it again, moving average. There it is. And you do 1 to 5 days and 1 to 200 days. And then you want to set this to bars, right here, bars, daily, daily, 1 day, okay? So we didn't find a losing trade. This is a high percentage winning swing trade, but there are losers from time to time. But we kind of can, we limit our losing trades by the price of the option. For the option, 1 to 2 strikes out of the money is good. 30 to 40 delta range, and at least, I would say at least 3 weeks out. 2 weeks doesn't give you a whole lot of time, but if you're in a pinch and the option's really expensive but it's a great opportunity, you could try maybe 2 weeks. But we always want to give ourselves the gift of time with options and decay. So that's it for this video. There'll be other complementary videos, and I might just add in the double up technique a little later, but that's the overall Johnny 4 technique. Thanks so much for joining me, and look forward to seeing you in some more videos.